If you want to know what is going to separate the wealthy from everybody else over the next 10 years, stop looking for magic stocks and start looking at assets. Most people will spend the next decade repeating the last one. They will trade time for money. They will buy liabilities and call them investments. They will mistake motion for progress. Then they will look up one day and wonder why nothing really changed. I have watched this pattern my entire life. People think wealth is built from one brilliant move. It usually is not. It is built from owning things that either produce cash, grow in value, or increase your ability to do both. That is the game. An asset is not just something your accountant can place on a spreadsheet. A real asset is anything that compounds your future. Sometimes that is capital, sometimes that is land. Sometimes that is your reputation, sometimes that is your own mind. If you understand that distinction, you stop playing a small game. So if I were starting from zero, or if I were helping someone build wealth over the next 10 years, these are the assets I would think about first. I would begin where most people do not begin, because most people are too short-term to see it. One of the longest duration assets you can ever own is the quality of the next generation you are raising. If you build wealth and then hand it to children who do not understand discipline, money, incentives, or character, you did not really build wealth. You rented it for one lifetime. I have seen fortunes disappear, not because markets collapsed, but because wisdom never transferred. The money survived the first generation. The habits did not. The judgment did not. The trust inside the family did not. If your children learn delayed gratification, clear thinking, and how capital really behaves, that education can protect wealth longer than any trust structure. It does not trade on an exchange, but it may be the longest compounding asset on the list. After that, I would look at leverage of a different kind. Artificial intelligence is not the asset by itself. The asset is your ability to use it. The world is moving into a period where the person who can direct machines well will outproduce the person who works the old way by a shocking margin. That difference will not feel large for a week. It will feel enormous over 10 years. If I can turn 8 hours of work into 90 minutes without losing quality, I have created capacity. Capacity becomes extra income, extra learning, extra time to study opportunities, extra time to build. Most people will use new tools casually. A few will use them systematically. Those few will look like they have some unfair advantage. In truth, they will simply be using leverage better than the crowd. Then I would think seriously about buying cash flow instead of waiting years to invent it. One of the most underrated ways to build wealth is to acquire a small business that already works. Not a fantasy, not a startup with no earnings. A real operation with real customers, real profit, and an owner who wants out. Most people are hypnotized by the romance of starting from scratch. I have never cared much for romance in capital allocation. If a business earns money today, has stable demand, and can be improved through better systems, better pricing, better management, or a bit of technology, that business deserves attention. There are owners who want to retire. There are businesses that can be bought at sensible multiples. There are situations where the buyer can pay over time from the business's own earnings. That is far more rational than spending years hoping an unproven idea one day becomes valuable. I would also want some assets outside the full control of politicians and central bankers. Not because I enjoy drama, because I understand incentives. Every government that controls a printing press eventually feels tempted to use it. That does not always produce catastrophe tomorrow, but over long periods it almost always reduces the purchasing power of paper money. So I want some insurance. Gold can serve that purpose in a different way. Bitcoin can serve that purpose. I do not view them as miracle machines. I view them as stores of value that sit outside the easy reach of money creation. They do not generate cash the way a business does, and that matters. But a small, thoughtful allocation to finite hard assets can protect the rest of a portfolio from monetary stupidity. I would never confuse insurance with my growth engine. Still, I would not ignore it. Then there is land, especially productive land. Warren Buffett bought a farm in Nebraska for a reason. Productive farmland does not need fashion. It does not need an app. It does not need a story. It needs people to keep eating. That is enough. Good land has two qualities I admire. First, it is scarce. Nobody is making more of it. Second, it can generate ongoing value while you own it. It can be leased, it can produce food, it can appreciate quietly while the world is chasing louder things. The returns may not feel glamorous on television, but glamour has never been my criterion. I care about durability. Productive land can be remarkably durable. Now, there are assets that can produce extraordinary returns. But they come with a different burden: private businesses before they go public, early equity and strong operators, angel investing in rare situations where the person, the timing, and the economics actually make sense. Most people are not ready for that world. That is fine. It is better to admit that than to pretend sophistication. But it is still true that the biggest gains often occur before the public is invited in. By the time everybody can buy, much of the asymmetry is already gone. The intelligent way to approach this area is not with ego. It is with humility, selectivity, and enough diversification to survive being wrong several times. This is not beginner territory, but for the right person with the right network and the right judgment, it can become a meaningful piece of long-term wealth creation. That word matters. Network, your reputation, and your network are real assets. They are not decorative, they are productive. A strong network is not a list of contacts. It is a group of people who trust your judgment, trust your character, and are willing to open doors because your presence does not damage their credibility. That kind of trust compounds. One introduction can change a career. One trusted relationship can surface a business acquisition before the market sees it. One reputation for being fair, competent, and reliable can bring you deals that money alone cannot buy. People underestimate this because there is no ticker symbol for it. But if I could choose between a mediocre portfolio and a first-rate network with a first-rate reputation, I know which one can produce the larger result over time. In the modern world, attention is another asset class. Not random attention, trusted attention, an audience that listens when you speak, a digital platform that people visit, a newsletter, a website, a channel, a brand, a software tool, a community, anything that gives you distribution you own instead of rent. For most of history, distribution was expensive. Now it can be built with time, consistency, and usefulness. If people come to you directly, you reduce dependency on gatekeepers. You can sell products, services, ideas, partnerships, and influence. You create optionality. The trouble is that many people chase vanity instead of trust. Vanity does not compound. Trust does. Intellectual property sits close to that. A book, a course, a framework, a patent, a system, a piece of software, a repeatable idea expressed clearly enough that others can use it and pay for it. That is an extraordinary category of asset because the cost of replication is low. You create once and distribute many times. I have always liked businesses with this characteristic. Good economics often begin where extra units can be delivered with little extra cost. Intellectual property done properly has that quality. It can outlive the hour in which it was created. It can continue producing long after the initial work is done. That is a powerful trait. Now let me move into a more familiar category. Dividend paying stocks, not speculative stocks. Not stories, productive businesses that send cash to owners. If I own a portion of a strong company and that company earns more than it needs, I want management to act rationally with that excess capital. Sometimes that means reinvestment, sometimes that means repurchases, sometimes it means dividends. The attraction of dividend stocks is not excitement. It is that they can pay you to wait. If the business is strong and the payout is sustainable, dividends create a discipline in the investment. They turn ownership into a stream of cash reinvested over time. Those payments buy more ownership, which produces more payments, which buys more ownership. This is not flashy. Neither is compound interest. Still, compound interest is how the world works. Alongside that, I would own broad index funds and ETFs. Most professionals do not beat the index over time. They charge fees with great consistency. Outperformance comes and goes. Fees tend to remain. The broad market, held over long periods at low cost, is one of the simplest wealth building tools ever offered to ordinary people. You do not need to prove brilliance every quarter. You need to participate in the productivity of the best businesses in the economy and let time work on your behalf. That is what a good index fund does. It gives you breadth, it gives you low friction, it gives you a default compounding engine under the portfolio while you spend your energy elsewhere. And then there is real estate, especially income, producing real estate. There is a reason so many fortunes have been built this way. Good real estate combines leverage, cash flow, tax efficiency, and inflation protection in one structure. Someone else can help pay down the debt. Rents can adjust upward over time. The asset itself can appreciate. And if you buy intelligently, the downside can be more forgiving than people think. That said, I do not worship real estate. Bad deals exist there just as they do everywhere else. But if you own well-located property that produces income, bought at a sensible price and financed rationally, it can become a deeply effective long-term asset. Owning your own business may be even more powerful. When you work for someone else, there's almost always a ceiling. Your time is finite, your upside is negotiated. When you own the business, the ceiling changes. You can hire, you can scale, you can build systems, you can create equity value that is not tied to how many hours you personally show up. This is where the real asymmetry begins. A profitable business can throw off cash for years, or it can be sold for a multiple of earnings that collapses years of labor into one large liquidity event. It is not easy, but it is one of the most direct ways to create wealth at scale, because you are not merely renting out your labor. You are building an asset that exists beyond the next paycheck. Now let me say something many people skip because it sounds too obvious. Your health is an asset, not a metaphor. An asset if your body collapses, your judgment weakens, your energy disappears, your attention fractures, or your time horizon shortens dramatically. Every other asset on this list becomes harder to build, harder to protect, and sometimes impossible to enjoy. A healthier person has more productive years, more disciplined behavior, more cognitive stamina, and more time for compounding to do its work. People love discussing returns. Fine, then calculate the return on staying mentally sharp, physically able, and emotionally stable for an extra 10 or 15 years. It may be the highest return on the list. A person who protects health creates more time for every other asset to mature. Time is the multiplier behind the multiplier. And that brings me to the first asset, the one that funds everything else. High-income skills. If you want to build wealth in the next 10 years, the starting point is not a stock, it is your earning power. Every asset on this list needs fuel. That fuel is excess cash. Excess cash comes from the gap between what you earn and what you spend. If your skills allow you to earn more, you widen that gap. If you widen that gap consistently, you feed the portfolio at a much faster rate. This is why I tell people not to obsess over tiny optimizations while ignoring their income capacity. If you can increase your earning power from $50,000 to $300,000, the math of your entire life changes. Your savings rate changes, your investment rate changes, your resilience changes, your optionality changes. Compounding begins to work on a much larger base. The best skills are not just marketable today. They are scalable, improvable, and difficult to replace. Sales done well, capital allocation, negotiation, communication, leadership, building systems, operating businesses, deep technical skill where the world continues to pay a premium for excellence. The person who becomes exceptional in one valuable domain often creates the capital to buy the other assets on this list much faster than the person who tries to get rich through investments alone. That is the whole structure. The next decade will not make everybody richer. It will widen the gap between people who own assets and people who only consume them. The person with high income skills can create capital. The person with capital can buy productive assets. The person with productive assets can create more capital without working in a straight line forever. And the person who understands reputation, health distribution, and long-duration thinking can make the machine stronger every year. So if I were looking 10 years ahead, I would not ask what single stock will save me. I would ask a better question. Which 3 assets can I begin building in the next 90 days that will still matter 10 years from now? Maybe it is your skill stack, a broad index fund, and an emergency reserve in high-quality hard assets. Maybe it is a small business search, better use of AI, and a serious effort to build your network. Maybe it is 1 rental property, 1 dividend portfolio, and 1 system for protecting your health. The specific mix will vary, the principle will not. Stop buying things that go down in value and calling that progress. Stop assuming income alone will save you. Stop waiting for motivation or the perfect moment. Most people do not fail because they lack information. They fail because they keep postponing action until time is no longer on their side. Wealth is built by owning things that produce. That is all this list is really about. Build the skills that create surplus, buy the assets that preserve and multiply it, protect the health, judgment, and relationships that allow you to keep doing it. Do that for 10 years with discipline, and the results will look dramatic to people who spent those same 10 years standing still. That is how wealth is actually built. Not by luck, not by noise, by ownership.